Hi, let's talk real estate. Let's get real. This is Darlene Dara from Century 21 Dreams, and I'm your host for this podcast. Wow, what a difference 24 hours makes. Doing a lot of reading, a lot of researching, and talking to a lot of people about the new Ottawa guidelines for both mortgages and for foreign investment and tax loopholes that they're trying to close. Sort of backtracking, why is this happening? Well, according to the government, it's happening because they want to make sure that the market remains healthy, that there is a fear that people are getting over leveraged as we continue to have record low interest rates for a prolonged period of time, and they want to make sure that if the interest rates rise, that the public can afford it. So they're implementing some stress test new guidelines. But let's be honest, and that's what some of these podcasts are about keeping it real. A lot of this as well is about public outcry about foreign ownership. People are really screaming about the fact that a lot of foreigners are coming in their mind and buying up properties and communities and affecting them. They're not necessarily ever intending and living in them. They're leaving them vacant, or they're renting them. They're leaving, they're changing the whole structure and the fabric of communities. So, and affordability, as the record amounts of increases in markets, particularly like Toronto. Although, to be honest, our local Oakville, Burlington, outskirt areas have been definitely affected. Maybe not quite as much as Toronto, but definitely have been affected. It has skewed buyers taking on debt. It has skewed many times sellers' expectations of what the values of their properties are worth. Record 33% increases in 1 year are really not sustainable. So part of it really is really a political answer to try to quell people's outrage at really how fast the market is going up and changing. So really a lot of it's about affordability. So the issue that a lot of us have in the marketplace is that the initial changes that happened out in BC are now being actually challenged in court, but they were a knee-jerk reaction without really ever having consultation, it seems, with people that are in the business. And yes, they did really halt a lot of activity, but they also affected a lot of locals, and really slapping on a 15% tax for foreigners at the time of purchase, really was that going to have a long-term effect, especially for people who were investing a lot of money and were just really dumping their money in the country. So there has been a lot of criticism of that one. So this one is a little bit different, but to be honest, there's quite a few questions as well as some answers, and sort of conflicting reports of what it means. So to give you an example, they're saying that there's a couple of areas that they're targeting. So one of it is about really the mortgages and this sort of stress test. And so part of it has been really talking primarily about insured loans where you're not having more than you have less than 20% to put down. So the concern again is that you have less equity. So if the markets change, that everybody, banks and CMHC, mortgages that are insured are taking a risk. So they're saying that they're really, specifically going after the insured loans. So what they're saying is that originally your stress test and what you would qualify for a mortgage was based on, the rate you were getting. So if you were getting, say, 2.5%, that's what it was based on. And they're now saying that originally you had to only qualify for borrowers who took a variable or a fixed rate with a term that was less than 5 years. But now, as of October 17th, and do note that some of these are being phased in, so the dates are different. As of October 17th, any borrower with an insured mortgage will have to qualify at the level of the Bank of Canada fixed posted rate. So right now, they're saying it's roughly 4.64%. So even if you're getting a mortgage at 2.3 or 2.5, just as an example, you have to actually qualify for it being at a 4.64% rate. So that's going to affect how much you actually qualify for as well. So that's really going to affect, and a lot of us in the industry are saying it's really going to affect people who were already having an issue about qualifying and affordability. So some people are saying that really people that, for instance, might go into townhomes will now go into condos. They're expecting that the 2+ condos market could really surge because of this. If people were trying to move up, they might not be moving up to as expensive properties. So it's going to have a rippling effect as well. So there's part of that. Where the question is, though, is that it seems to be about mortgages that are insured. And again, the other misnomer of this is that a lot of people think I personally, don't need mortgage insurance because I'm putting down more than 20%. But if you're going to a lender that's doing what they call portfolio insurance, and that sometimes does happen where you might not qualify at a conventional bank, but you're going to another type of lender, but they're actually insuring all of their mortgages. They have to go through this same stress test level, which is at the Bank of Canada rate. So, just because you're the person you're getting, or the company you're getting the money from, might actually still be insuring those mortgages. So you would fall under that category. Where the big question for me and a lot of people right now is that if you're not actually needing a insured mortgage, i.e. you've got 20% or more down payment down, are you going to also be at the same Bank of Canada fixed posted rate? That's the question, and they're saying that that's really undetermined. Now, truthfully, if you have the whole idea of having at least 20% down is really, if the market did correct itself, that the exposure is not quite there. So really, personal opinion, to really put a blanket statement that everybody has to be at the Bank of Canada posted rate doesn't, in my opinion, seem to be fair, because then why bother putting 20% down if that's the case? So it really doesn't make any, you're not really being rewarded for having enough money so that the risk is less. So that's really one big question. Okay, so now another disclaimer of this is that this is for new mortgages. All these dates are for new mortgages. It's not affecting an existing mortgage or renewing a mortgage. So again, an existing mortgage, if it's before these dates that will occur, you won't be affected. So again, if you're sort of on the borderline, if you're right in the middle of a deal, that you've got a firm deal but you haven't yet closed, you need to, and especially if you would have been, one of these insured mortgages, you need to ensure that you're actually going to qualify based on these new rules. One other thing people are saying is that lower priced properties could really become even more demand, which is like mind-boggling to some of us in the industry, because some of those properties, there's such bidding wars already on. So it could really strain certain pockets of the market as well. So the next thing is really about trying to address speculation and also foreign ownership. So we really, as Canadians, have very few areas where we're not taxed, and one of them is the principal residence and the capital gains tax exemption on the sale of your principal residence. So now what they're saying, and again, there's a question mark here with this, is that they're saying it's only going to apply to people who live in Canada the year the home was what? This is where the question mark is. Some are saying it's when it was purchased, and there's other articles and conversation about it's when you sell it, because truthfully, when you buy a property, now BC has slapped the 15% on when you're actually purchasing it. You're really, though, if you're the tax exemption as far as the profit is really at the sale. So some are saying that it's being also applied when you sell the property if you're not a resident at that time, or is both really applying, that it's your principal residence when you bought it and sell it. So this question is interesting, because you could not be a resident at the time, but you bought it thinking you were coming. There was some conversation yesterday about foreign ownership, where people are buying these properties and the owner is not living in them. They're having another relative live in them, like say a wife or a spouse or something, or kids, and then they're selling them and making a profit, but they're really not, the owner's not a resident, they're not living in Canada. So they're trying to really tackle that issue. So really, it's really about making profit and not paying back the tax that is owed. So sort of bucketed into this is the fact that CRA is now going to require disclosure of principal residence, which wasn't really happening fully. And there was also, although some articles are not mentioning it, there was talk about it also being limited to one principal residence sale a year. Now, a year, is that a calendar year, or is there that within a year for a person? And then that brings up questions with how many principal residents somebody can have, because technically under the Tax Act, there's conversation that it could be two, because you could have, you live part-time in one house and then a seasonal somewhere else. So, a lot of people, when you ask them the question, how many homes can somebody have as a principal residence? As Canadians, we often just say one, but in fact, that may not be the case. So again, your individual situation, you would have to talk to a lawyer and your tax expert. I'm not trying to give legal or tax information out here, but again, some of these things are really raising more questions than answers. And again, that once a year. Again, is that a calendar year, or is that you bought and sold and then you went in and you still owned the property for a year? Year meaning 12 months. So that's the other question as well. So really, it may affect foreign ownership, but again, percentage-wise, again, we're talking how much really. Some people are saying it's 3%. So how is it going to really affect the real estate market? So we'll continue with this conversation as it flushes out a little bit more, to be honest, because a lot of people are trying to digest, and again, the government is saying that some measures will be coming down the pipe, but at this point it looks primarily that it's about foreign ownership and tax loopholes, and also what will really affect as far as Canadians is really going to be about mortgaging and the stress tests, and it right now seems to be primarily about the insured backed mortgages that are insured versus ones that are not. So hopefully that helps, and I'll keep you posted on more information on this as I get it. So take care, have a great day, and I'll see you at my next podcast.